Good morning, ARMR Insiders. Thank you for joining me and starting your trading session with me today. Appreciate you being here. Let's get down to cases. This is a risk monitor red with vengeance. That's what's going on right now in the market. So we're going to go over what our processes are here on the ARMR trading desk, how we're managing portfolios that are conservative, balanced, and aggressive. We'll walk through all of that, talk to you a bit about what's on my mind today and how we're going to handle the Fed meeting and the results that come out at 2:30, and then the conversations with what's 2 o'clock that drops, and then 2:30 we'll hear Powell speaking. So we're going to go over all that in a second. Don't forget what we're doing here, as always, is taking a look at the 3 essential stages of managing capital. This is a virtual hedge fund trading desk. That means that you're bringing your own capital, you're your own portfolio manager, and we're following these 3 stages. We build our whiteboard of fundamental research. We use algorithms to tell us when to put money to work and when to take it out of the market. And we use stop loss rules and risk management rules to protect ourselves, because even the best probability algorithms, and ours are pretty good, all right, are going to be wrong a couple times. And that's what's just happened. So you have to protect capital. You could put capital to work when windows open and you're on the right side of probabilities and statistics, and you immediately raise cash if that is not expressing itself in the direction we think. All right. So that's where we are today. Let's talk about all of these things. Don't forget, I don't know who you are. I'm speaking to you all collectively as portfolio managers. You got to make your own individual choices about risk management, risk tolerance, goals, and all these other things. So the object here, the ARMR Report, is to share with you the information flow that we can generate to help you be a better portfolio manager. That's the point. All right. Things that are on my mind. Let's start with that. Okay. Let's start with a look at the S&P, because I always like to start there to kind of order my thinking. What we have is 4 days, really 5 days now, of a market decline with extreme volatility and aggressiveness. So I spent a lot of time yesterday going through all of my recent positions, all different groups and sectors, trying to get myself acclimated again to the trading desk after taking 4 days off to be on a family vacation, which happens to be the worst 4 days probably in the last couple of years to spend time away from the desk. Okay, it happens. And a review of this particular collapse in the market is very disturbing. I want you to take a close look at it. What we have is a head and shoulders top. We all knew that. We had a breakdown to this May 4th Fed meeting where they got real hawkish. And then we had a bounce, right? And typically when you get that breakdown of a head and shoulders top, we're looking for the bounce to run back to the neckline, which is the 200-day moving average test. It can punch through sometimes, and if not, roll back over. So looking for that move. And instead we had this, sell-off, with extreme prejudice going on in the market. So what's on my mind from that? The velocity of the decline is disturbing. The lack of VIX movement out of the range it's been in for months is very telling and unfortunate. Okay? The velocity of that sell-off, you should have seen VIX skyrocket. And I know guys will explain to me that there's different functions of VIX and expiration. None of that matters to me. When you see the market implode like that, VIX generally skyrockets. Okay? Those things about OpEx and futures expirations and rolling, those things help us in a normal environment. But as we're seeing with spot gamma information when it comes to the equity markets, it means nothing when the market starts going down. There's not that bounce higher into a Friday OpEx. It doesn't matter. The market just implodes, right? And so VIX should be able to release itself from the shackles of typical month-end OPEX future, whatever behavior, and it should be rallying right now out of that base in an aggressive way. And instead, it can't even get up to the top of the range. Meanwhile, the market's imploding for 5 days. That's very telling. It tells me that this market decline is not going to be over in a short period of time. Okay. When VIX skyrockets, then you know you're at capitulation stage. And the market could keep selling off for a month or so, but you're getting to that stage of wipeout and then recovery. So if the market plummets and there's no explosion in VIX, you're not even close to that period, which is disturbing. It's telling and it's disturbing. There's nowhere to hide in this market, which is incredibly frustrating. Normally in a equity market that's in decline like this, for instance, treasuries would start going up. Okay, you can't hide in treasuries right now. Treasuries are leading the market down because the Fed's out there raising rates. We have an inflation problem. If you remember, the collapse of 2020, okay, treasuries were a great place to hide. There was a pandemic. Everyone hid in treasuries. You can make a lot of money in treasuries. The market imploded. We made some of that money, okay? No place to hide in treasuries right now. How about, why not utilities? That's a great place to hide. It's been a wonderful place to hide right up until this week. Until this week, totally wrecked utilities. This is the utility ETF. Now, look, XLU should have been down months ago. So I'm not surprised. You're saying to me, well, of course it should go down. Rates are going up. Long bonds are getting wrecked. So utilities should go down. That's what they normally do. But my point to you is they haven't. It's been a place people have been hiding. So I want to go back to discuss, a market, the anatomy of a market collapse, okay? Because we're in the throes of it right now. At the beginning of a top right here, which is what's been going on, this head and shoulders top we've been talking about, a smart portfolio manager can dance between the raindrops and find sectors of the market and groups that are collecting capital so we can increase net worth even though the indexes are going down, right? So we avoid the ARK funds. We avoid, all types of excessive growth stocks, big cap growth stocks, because those are the first groups to get crushed in a market like this. And at the ARMR Report, we were able to increase net worth in 2022 by focusing on the right groups, commodities, led by energy, okay? Dividend stocks. Our dividend portfolio is doing great, okay? And we can see that it would be doing great because if you use XLU as a guide, because it's like basically owning utilities, you're not buying that for growth. That's clearly just to collect your dividend. So your yields there will follow the bond market. So right through the beginning of this year, the yields on XLU, hey man, the rest of your dividend portfolio is going up, okay? What happened in the last 5 trading days was annihilation in utilities. There's no place to hide. That's very frustrating in a market where you have inflation, so that what happens is the only place to hide is cash, and there's massive inflation. So that's not really a place to hide, right? I mean, it's true the US dollar is skyrocketing, and one day I'll figure out why this is happening, but the US dollar is skyrocketing versus all other currencies. That's what this tells you. It doesn't tell you that the buying power of the dollar is going up and it helps us. No, it doesn't help us. The inflation is still real, but every other currency in the world is doing worse than the US dollar. My question is, where's the money going? Typically for UUP to go up like that, it's the ETF of the dollar against a basket of other currencies, money would be flowing into treasuries, for instance. And as it flows into treasuries, people have to convert euros into dollars. So they're selling euros, buying dollars to buy treasuries, right? That's not happening. Treasuries are imploding. So what are people doing? selling euros to buy dollars to put it in money market funds? Maybe. I mean, maybe if you're European, it's better to just own dollars because the dollar is going up versus your currency, right? But now I'm off, into the weeds right now. So let's get back to our focus. The point is, there's no place to hide in this market, and it's incredibly frustrating. But you have to take a close look at this chart and recognize what it means for a portfolio manager. If you've been, and I have different portfolios, and I share with you what I do in my portfolios. If you've got a portfolio structure that is hiding in dividend stocks, which is what I do, right? It's been wildly outperforming for the last 12 months, right? Just got thumped on the nose in the last 5 trading sessions. And that wakes me up. Whoa, hold on a second. What's happening here? I'll give you an example. Here's just a couple of ideas in the portfolio. We got stopped out of Pfizer, right? It was a dividend play. We bought it here. It went up, boom, imploded out of Pfizer, right? We own some AT&T. You could probably hold on to it, right? Bought it here. It ran up. It's come back. But the selling is aggressive. And it's a major Dow stock. It's hard for me to hold Dow stocks in the midst of a Dow collapse. Right? This is what's going on in the Dow. Okay? I haven't looked at Verizon. So Verizon's going nowhere. Right? How about one of my favorites, Altria? Totally imploded. Totally imploded. Now, we bought it down here. We had a good run. We collected some dividends. We booked profits and the whole thing. But you can see what I'm talking about. Places where people have been hiding, places where I've been willing to dance between the raindrops. And let's get back to a view of the S&P so I can just walk you through where we're at in the stage. Okay? Whoops. Well, there's momentum that looks god-awful. Okay. All right. Take a look at that picture. I'm going to grab a quick sip of coffee. Okay. So to go through the progression of a bear market, when you get first the head and shoulders, there will be sectors of the market. People don't believe it. This is how kind of emotionally it goes. You've had this huge bull market run. There's been a collapse in the last 12 months of growth stocks, and people just kind of sweep that under the rug and say, oh, they were just overvalued. It doesn't mean anything. Big head and shoulders top on the big indexes. So now all of a sudden they start wrecking the NASDAQ 100 type names. Okay, people say, well, they were overvalued. That doesn't matter. And they keep shifting money into other sectors. We've been doing the same thing. We shifted money into dividend stocks. They're working. We shifted money into energy stocks. They're working. Okay. We traded precious metals during the year, made some money on it. Okay. Now we're entering a stage, and this is the point of this morning call right now. Now we're entering the stage where nothing's safe. And so while I'll dance through the raindrops at the beginning of a market breakdown, because you never know, you don't know that the market's going to collapse. Don't believe anybody out there that tells you they know. They don't know. Okay. We have ideas, we have macro opinions, but these things change constantly. All right. So we just execute. We get entry points, we execute, but then we use the information we get off of our execution to direct our risk management approach. So when we get a risk monitor green that goes nowhere and then implodes, we say, wait a minute, something's changing. And we're going into the next phase of the bear market. That's the phase where nothing's safe and you don't dance between raindrops because the hurricane's coming, right? You could dance between raindrops a little bit before the hurricane gets there. And then you got to batten down the hatches until the storm passes. I don't know if it's going to pass in a couple of weeks. It'll take months. I don't know. The fact that VIX isn't going up is disturbing. Makes me think it's going to take months. If VIX skyrockets and the market plummets, then I'll say it's going to take weeks. Okay? So the purpose of this conversation this morning is we're at that stage where I care more about protecting my capital. Look, the ARMR Report has tremendous alpha versus the market. The market's plummeting. Now, we were up on the year. I'm talking about an average ARMR portfolio now. I manage many different portfolios. Some could be up a little bit still for the year. Some are down a little bit more for the year. Okay. But somewhere in there, we're plus or minus, let's say, 3% on either side of break even for the year. That's tremendous alpha as the market's plummeting. Our job is to protect our capital right now, even after the last 5 days, which are incredibly frustrating, right? Because my aggressive portfolios went from, I don't know what we were, up 4% for the year to, I don't know, down 3 or 4% for the year. I mean, in literally 4 trading sessions. And that's with carrying cash. I mean, I had cash positions in the portfolio. So even in my aggressive portfolios, I was still carrying like 30% cash. I mean, the selling's intense. So you can't get frustrated by that and go, oh, I can't believe it. You got to stay alert, use the information, and then adjust how you're managing the capital. But you also have to take a step back and say, hey, wait a minute. My alpha is enormous. If I can keep my net worth right around break even as everybody else is imploding, then when the dust settles, when the rain stops, if we stay with that analogy, that metaphor, the rain stops, okay, and the sun comes out, we're going to be at new equity highs way before the indexes or anybody around you. That's our goal right now. We may be plus a couple percentage points, negative a couple percentage points, doesn't matter. We stay right around break even and we wait for the next opportunity. So what am I doing right now? What was my action? When I spent all the time yesterday kind of going through everything, all the charts, trying to figure out where. Oh, and I haven't even mentioned precious metals, right? Normally that would be a place to hide in an inflationary bear market, right? But even precious metals. And this big up bar Friday caught me. I'm here to tell you. I'm happy to. I keep it real. The ARMR Report. I tell you when I hit it right. I tell you when I hit it wrong. Market plummeted Friday. ARMR portfolios were off like 0.5%. And the reason for that is we had large allocation to precious metals. And they ripped higher Friday. I thought, that's it. That's it. A higher low, perfect double bottom. Look at the GLD. I'm just using GLD as an example. Closed above all the key, or right at the 50-day, and closed above the 200-day moving averages. Closed at a new high since we'd started buying them. I said, that's it. Totally imploded the next 2 days. There's nowhere to hide. I've been blown out of my precious metals positions again. Because when you have a huge up bar like that implodes in the next 2 days and takes out the low of that bar, that's my stop. I don't care my opinion of what gold and silver should do. Because people that force their opinion on the market about what an asset should do get carried off the trading floor on a gurney. So I take my lick. I have a day where I turn the computers off and I get my son and we go to the beach and we fish and I forget about it. I say, okay, that's the way it went. Boom, come back to the desk today. What's the approach today? That's the question. So as of yesterday, I am in a max cash position in every portfolio. That might be 100% cash, could be 90%, could be 85% cash. The only thing I'm carrying right now are my energy pipelines. We bought them real early. I've lived through scenarios like this before. I expect the pipelines, even if they come back to where I bought them, they're going to be paying me a 7+% yield, and I'm going to collect that in some of my portfolios, right? So I might have 15% exposure, 10 to 15% exposure in the pipelines. That's it. The rest is cash right now. I think it's also incredibly important when you go through a couple of days where it's a bit of a shock what just happened in the market, to feel like it's okay to take a break, raise cash, take a break. I'll tell you what normally happens when I do this, right? I raise cash, aggressively, and I take a break. And then the market skyrockets for a couple of days. I guarantee that's going to happen. I guarantee, right? There's no guarantees. But I'm just saying, the probability is the market's going to rip higher for a couple of days is enormously high. One, because the market's down 5 days in a row and it's been unbelievably aggressive. Two, the Fed meeting today. So how are we going to trade that? We go to the ARMR day trading playbook. Let the news come out. Let it settle. Let Powell start speaking at 2:30. Then if we have one of the 5 ARMR entry points, we put money to work in the indexes. Okay? And that could lead to a rip higher in the market. And because we've got so much cash, I might carry some position overnight in the indexes, really in just the S&P, to capture some of the upside. So I'm going to be day trading and swing trading. I wouldn't even call it swing trading because it's something I would hold for a day or two overnight. It's not going to be something I hold for weeks. So swing trading is usually more of a week to week hold. So I'm going to be day trading, and I'll allow perhaps a part of that day trade to carry overnight. Okay, if we capture some massive move and the market's going to rip for a couple of days, I'll try to capture some of that. So my sole focus on the desk right now is to protect capital and capture some upside in the indexes. I'm going to be long and short the indexes. Okay, that's what I'm going to be focused on. I thoroughly expect the market to go up for a couple of days now because the market generally is the most frustrating it can possibly be at these moments. So when you raise a lot of cash, then the market goes up and you're like, I can't believe that. You start banging your head on the desk. Right? Don't do that. Take a step back. I don't care if the market bounces for a couple of days. Right? The carnage that's going on in the market will take weeks to unfold and create a real investing bottom. I'm willing to take a shot right here on the S&P on this risk monitor green signal right here because we have the first breakdown of the head and shoulders top, okay? And then you usually get a pretty aggressive bounce off of that. That didn't happen. Now we're in free fall. So any moves that can always, in a bear market, the largest 2-day moves happen in bear markets. So I wouldn't be a bit surprised to see the market jump 6% in 2 days. Just rip. Okay? And then roll over and implode again. I'm going to be in the process now of looking to put on investing shorts on the rips. And I'll be day trading long the S&P. And I might carry along overnight for a day or two and then start putting out shorts or buying puts on the indexes or however I want to do it. That's the stage I think we've entered in this bear market. I'm going to stay nimble. I reserve the right to change my opinion. I'll see you tomorrow at 8:30 and we'll talk about how the market's behaving. But as of right now, that's the information I wanted to share with you. And I'm happy to take some questions. It's 9:02, so I've got to get to setting up our trading desk. But anything else on your mind, I'm happy to answer a question if you've got it. If not, I'll see you guys on the live desk. Okay, I think we're all on the same page here. I'll give you a minute just in case. I'll make share one other thing while we're waiting in case you guys have a question. I like to look at some of the part of what I did yesterday is to go over a lot of the stocks that I've traded in the last month that I don't own to see how they do. Did I miss any upside? Is there anything making money that I could have been in? And this is another thought. I'm glad I took a minute to think about this before we split because I wanted to say this today. Energy will not last in this market. If the market keeps imploding, the baby gets thrown out with the bathwater. Energy could be the first group higher when the dust settles, the rain stops, but they are going to rip energy down. That's just what the market does. Let me tell you another thing. And I'm not going to crow about it too much today. I talked about it yesterday, but when Bitcoin was above 60,000, I tried to explain to everybody, it's not going to 100,000 like Tom Lee's talking about, okay? That guy's talking his book. It's not going to go. Do you remember that day we had a conversation? I said there are guys now on Twitter that are legitimate portfolio managers that are putting out reports and making comments and talking to anybody who will listen that Bitcoin's going to $2 million of Bitcoin. If that's not a top, I told you that then. I said, that's not a top. I mean, you'll never see a more clear top. When a guy who owns way too much of an asset, probably on margin, starts telling everybody else it's going to 2 million and it's trading at 60,000, you know the person's desperate. Right? Now we have, and I went over this yesterday, so I'm not going to go over it again, but now we have one of those cryptocurrency banks that are basically, there's a run on the bank and they're not letting people take money out. So in case you were wondering, why am I bringing it up now? MicroStrategy, I keep harping on this, but I think it bears discussing. Okay, there's MicroStrategy. And so in case you're wondering where I am on this discussion, because this morning, Michael Saylor comes out, the CEO of MicroStrategy, there's no margin call, right? He's telling you there's no margin call. He told you there's a 21,000. That's going to be the margin call. Now we're below 21,000. Now there's no margin call, right? So then the tap dancing starts. This is classic behavior, okay? And there's analysts that come out, oh, there won't be a margin call now. There's more than enough collateral. Oh my God, let me tell you something. The sharks are circling. They smelled the blood in the water over a month ago when I said to you guys, when Bitcoin was above 30,000, I said it's going to go to 21,000 because it's going to hit the pain point. Now it's going to go below 21,000 and the tap dancing starts. Analysts start, and who knows, they're paid analysts of MicroStrategy. Probably they're the analysts that help MicroStrategy float bonds, right? Debt, so they could buy a whole bunch more Bitcoin at an average price of over 30,000, right? So now they got $1 billion worth of losses. They're just paper losses, right? Then they start telling you that, oh, they're just paper losses, right? But they were happy to tell you there were $1 billion in the green. Those weren't paper gains, right? Oh, Michael Saylor was everywhere on the internet talking about how great he was because he had $1 billion worth of profits in his Bitcoin position. But now he's got $1 billion worth of losses, and it's just paper losses. Don't worry about it. But this is like following every other bubble asset collapse that I've ever witnessed or read about. Bitcoin's probably going below 10,000. There, I just said it. So I was saying to you the other day, on my trip, we went to Titusville with the boat, got an Uber to take us to dinner. And the Uber driver's asking me about crypto. Number one, we know crypto's going lower because the Uber driver's asking me about crypto, right? Crypto will bottom when no Uber driver asks me about it. They don't want to talk about it, right? They don't want to say a word about it. That's when it'll bottom. That's the research I'm going to do with you guys. I'm going to share it. I'm going to go on trips. I'm going to not even go on trips. I'm just going to take Ubers around Jupiter. And when I finally take an Uber and the person doesn't ask me about crypto, that's when I'm going to come on this show in the morning and say, guys, it's time to start buying Bitcoin. Because nobody's asking about it anymore. It's probably going below $10,000 a Bitcoin. Number one, because it has to wipe out Michael Saylor. That's my opinion. I've been saying it for a while. I'm going to keep saying it. And the tap dancing he's doing now just proves the point to me. But it also has to wipe out, unfortunately, all of those poor souls who thought they understood capital markets. And really, they were just piggybacking on Fed largesse, and they didn't understand it. And so what they did was they became millionaires, and they're going to lose all of the money. They have no risk management rules. They pretend that they're going to hold on for dear life, and they're going to get wiped out. When that happens, then there will be some gems in the crypto space, and I'm probably going to start buying it. But my guess is it's got to go probably below 10,000. I don't know. I mean, I'm just making up numbers now. I knew it would go back to 21,000 because that's the pain point. Now the tap dancing starts and it goes below 21,000, right? Then Saylor gets the margin call. So why do I say it's going to go below 10,000? At some point in here, there's going to be a margin call. Then what does he do? He sells Bitcoin into a vacuum. Who's going to buy it? I'll tell you who. other sharks, other billionaires who are going to put him out of business and collect his Bitcoin under 10,000. They'll say, sure, we'll buy your Bitcoin right down here. Give it to us. Give it to us right here where you can collect the capital and go pay off your loan and not go bankrupt. That would be somebody saving him. Typically, these situations end in bankruptcy. Anyway, those are my thoughts for today. I look forward to seeing you all on the live trading desk. I'll get that fired up right now. I'm looking long the market today. When I carry this much cash, my job is to get long, if I can, the indexes to capture some upside while I wait for the next risk monitor green signal. So in some markets, when the risk monitor is red, I'm willing to dance between the raindrops. In this market, I'm not. I'm not putting money to work till the risk monitor goes green. So right now, my sole focus is day trading the indexes, capturing some upside, maybe carrying that overnight every now and then until we get to the next risk monitor signal. Any purchasing I do, any investing I do is going to be on the most liquid index, which is the S&P. That's it. And for those of you who don't want to trade like that, and I totally get it. It's not easy. Okay. That you don't have to do anything. My conservative portfolios, I'm just sitting in cash. All right. All right, guys. Have a great trading session. I'll see you on the flip side. And thanks for joining.